Hello everyone, welcome to Bhadra IAS online Nagaland Civil Service. Today we are going to discuss what is the difference between the reverse repo and the another concept called SDF, the standing deposit facility. Okay, the SDF is newly introduced by RBI in 2022. Therefore, it becomes current affair also for your exam. This will be part of your economics. Okay, so now there are two different rates. One is called reverse repo, other one is SDF. What is the difference between these two? Okay, so now let us look at here a simple understanding. I made this diagram to make it clear for you. Now what is the reverse repo concept? Reverse repo is generally understood as the rate of interest paid by RBI to the banks when banks deposit their surplus cash with RBI. Clear? Therefore, it is basically a rate of interest. You can understand that way. So, reverse repo is the rate of interest which RBI gives to banks when they deposit their surplus cash with RBI. So, now normally what happens? Suppose there is a bank called SDFC. It deposits money with RBI. Okay, surplus cash it deposits with RBI, and so the cash goes from SDFC to RBI. RBI gives interest to SDFC. This interest is called reverse repo. Okay, now normally reverse repo operations are basically for short term. Okay, it is called overnight. Okay, now important thing to understand, the difference between SDF and reverse repo lies here. The difference. Normally in reverse repo transaction, RBI uses collateral. It gives collateral to the bank. Actually banks repurchase, that is the reverse repo. They repurchase the collateral from the RBI at a lower interest rate. So in reverse repo, banks deposit money with RBI. RBI gives them an interest, and RBI for this transaction uses the collateral. Okay, now let us look at what is SDF, the standing deposit facility. The SDF is also very similar to the reverse repo. It is almost same, you can say, right? So what happens here? Same like the reverse repo, SDFC deposits money with RBI and RBI gives interest to SDFC. It is also meant for a short term. So what is the difference? The difference is in SDF, RBI does not give any collateral to banks. In reverse repo, RBI gives collateral. In SDF, RBI does not give any collateral to the banks. Clear? That is the difference. So now to make it easier, I put these differences there. Reverse repo is a short-term loan. SDF is also short-term loan. So point number one, there is practically no difference. Okay, these are same. Point number two, reverse repo, RBI gives collateral to banks, but in SDF, RBI does not give collateral to banks. Clear? Third, understand, in reverse repo, the rate of interest is lower than SDF. In reverse repo, rate of interest is lower than SDF, whereas in SDF, the rate of interest is higher than reverse repo. Clear? So these are some very key differences between reverse repo and SDF. SDF is newly introduced by RBI in 2021. Therefore, it can be asked in your exam, and so this video will help you to understand these concepts of reverse repo and SDF. Clear? So if you have any query or you need any more information, you can contact Bhadra IAS online at 8638391721, and keep following our videos. We'll give you more topics for your exam preparation. Thank you.